Let's review a few very important partnership concepts first. What is a partnership? A partnership consists of two or more people jointly conducting a business or trade that is not incorporated. A formal written partnership agreement is not required but highly recommended. Sharing expenses or co-owning a property does not in itself constitute a partnership. To be a partnership, there must be active conduct of a trade or a business. For example, a group of brokers who form a partnership and give investment advice to others is engaged in the active conduct of business. A general partnership has two or more general partners. A limited partnership has at least one limited partner but must also have at least one general partner. A general partner, whether in a general partnership or a limited partnership, has unlimited liability and can make decisions and manage the business. A limited partner, on the other hand, cannot participate in management, but has no risk beyond his investment in the partnership. Partners are not employees. They own the business. The partners must pay taxes on their share of the partnership income, even if they leave their profits in the business and receive no cash or property. They pay no taxes on withdrawals of capital from the business unless the withdrawal exceeds their adjusted basis in the partnership. Imagine that Mary is the only general partner and Teresa is the sole limited partner in M&T LP. Each has 50% ownership in the business. Although Teresa was the main source of startup capital, she leaves running the business to Mary. Mary takes a draw each month but does not withhold taxes from the draw. Instead, she makes estimated quarterly payments. At the end of each quarter, Teresa receives a check representing her 50% share of the profits for that quarter. She also makes estimated quarterly payments. If M&T LP were to run into financial trouble, Mary would be wholly responsible for the company's liabilities, while Teresa would only lose her partnership investment. What about self-employment tax for partnerships? General partners pay self-employment tax on their share of the partnership's income, plus any guaranteed payments that they receive. Guaranteed payments are payments to partners for the use of capital or for services to the partnership. These are usually specified in the partnership agreement, and these payments are deducted from partnership income before determining the partnership's profit or loss. Limited partners are generally not subject to self-employment tax on their share of income unless the income is a guaranteed payment. Among the many reasons for which a taxpayer might choose the partnership form of doing business, the most compelling include the following. An unlimited number of partners can combine resources and capital. Partnerships are permitted flexible arrangements, including special tax allocations. And finally, partnerships are not taxed per se. Profits and losses are passed through to partners. How about LLCs? This type of entity is a blend between partnerships and corporations. It offers the advantages of the limited liability of a corporation and the taxation benefits of a partnership. A limited liability company, or LLC, integrates the ability for all members to manage the business with the limited liability shield, the best of both worlds, without incorporating. The LLC members can manage the business themselves, or they can designate someone else to manage it. The LLC offers the advantage of limited liability to all members, even if they fully participate in the management of the company. The members are protected from personal liability due to the entity's limited liability status. For tax purposes, LLCs with more than one member are deemed a partnership subject to partnership reporting rules. Single-member LLCs, if permitted in the state, are treated as proprietorships for tax purposes.